Hello, everyone. Welcome to today's presentation. Please drop a comment in the chat. Let us know that you can hear us and that you can see us so that we can make sure everything is working over here. And also just let us know if you are a cannabis operator, a cannabis business owner, or like an ancillary business provider, like an accountant or marketer. I did see a couple of comments earlier, but I just want to be sure everybody can hear us. All right, so Dorothy is saying Happy New Year, Happy New Year, Happy New Year, everyone. Can you guys hear us? Accountant, okay, well, you're answering the questions, so it looks like you can hear us. So I'm just gonna go ahead and get started. Okay, so welcome to the National Associations of Cannabis Accounting and Tax Professionals monthly webinar series. I'm your host, Naomi Granger. I'm the founder and CEO of NACAT Pros. During this session, we like to bring you educational topics that will help you add value and better serve your clients who are operating in the cannabis industry. So today's guest is Richard B. Weed, CFA and SVP of Client Development at SES ESOPs Strategies. He's here today to help us as cannabis accountants and operators cut through the ESOP weeds. I had to do it. So Richard will explain where ESOPs can create tax-efficient exits. Sorry, I lost my notes. Richard will explain where ESOPs can create tax-efficient exits for cannabis owners and what that means for your financial statements. With that, I'll just let you take it away, Richard.
Okay, thanks, Naomi. If anybody wants to address me in the chat, I'm Rick. Naomi, I'm only Richard when my mom's mad at me, so hopefully no one will be mad at me. Thank you for this. So again, everybody, my name is Rick Weed. Yes, that's really my last name, Rick Weed. It's been in my family since I think the 1700s. So I guess I'm uniquely qualified to speak about cannabis. So
right, and when I first met you, Rick, and I saw your last name, I was like, I have to have him. I have to introduce him to my audience.
So I work for a firm called SES ESOP Strategies. We are ESOPs, employee stock ownership plans. That's all we do. We're a division of a big law firm based in Pennsylvania, Stevens and Lee. And we have 8 full-time ESOP attorneys, 8 full-time financial analysts, investment bankers, and employee stock ownership plans are all we do. So I'd like to describe ESOPs and how they can help anybody who is in a cannabis-related field, a cannabis firm. So with that, let's pop to my presentation, and I'll talk about how they can create value for an ESOP can create value for the owners of the cannabis company, the employees, and any of the advisors. So the first question, what is an ESOP? Well, an ESOP is an employee stock ownership plan. Often confused with employee stock option plans. This is very, very different. An ESOP is a form of a qualified retirement plan, just like your 401k is a qualified retirement plan. Actually, ESOPs were set up with ERISA in 1973, and the 401k is actually section 401k of ERISA. So it was set up with the exact same law in the 70s. So it's an ESOP is a defined contribution plan, or defined contribution retirement plan. So companies will make defined contributions into this plan for each employee every single year. And over time, the value of this will grow and grow and grow as the company does well over time. And then this is a retirement benefit for all of the employees. Now, they are regulated by the IRS as well as the Department of Labor, which is in charge of retirement plans. So, and because they're so tax favored, there are regulations around them that you really need to set up the plan correctly and have good legal assistance to make sure everything is doing well and legal going forward. They ESOPs also balance two interests. They have to be flexible, so employers will want to set this up for the employees for benefit going forward. Yet at the same time, they can't be too flexible, because if they are, I know this might come as a shock, but people will actually try and abuse this for tax benefits. So we're very, people who set up ESOPs are very, very careful about setting it up properly to make sure everything is legal and people are getting as much benefit out of it as they can, as much tax benefit. So ESOPs can take two different forms. Now keep in mind, an ESOP, this is, again, employee stock ownership plans. So stock of the company is going to the employees, and the employees are going to end up owning the company over time. So there's two main forms. One is a non-leveraged plan. There's no debt. You're not borrowing any money. And what the company is doing is it's making contributions each year to the employees. And those contributions purchase stock of the corporation. And they're held in trust with a trustee, and each person has their own plan, just like in the 401k. It's set up just like a 401k. And you can see how much stock you own, how much the stock is vested, and what the stock is worth each year. That's a non-leveraged plan. A leveraged plan is a little bit more complex, and it's actually very good for the business owners. You can take a loan. The company will take a loan to set up the plan, purchase all the shares of the corporation, and as the company pays the loan off with the bank, shares are released to the employees' accounts. Why would you want to do this? The reason you would want to do this as the owner is you get all of your money up front. That helps the business owner. So,
and also loans are not taxable.
Correct. So what happens in an ESOP is when you take the loan, right, as the loan is paid off over time, the principal and interest is deductible. Any business loan, the interest is deductible. However, because it's an employee stock ownership plan and you are making contributions for a retirement plan, just like 401k contributions, they are tax deductible for the company. So I'll go through that in a little bit. I have a few examples of how much it will help the company when you set up an ESOP. So good question. Thank you, Naomi. So what are the benefits of an ESOP to all the stakeholders? The first is the owners of the business, the shareholders. If you are selling your company to the employees over time, there's something called a 1042 transaction. So if your company is worth, let's say, $100 million and you sell it, if you sell it to private equity, you sell it to a third party, you're probably going to pay about $40 million in taxes. With an ESOP, you can defer all of those taxes by purchasing something called qualified replacement property. So if you do that, you take $100 million, you purchase $100 million of QRP, no taxes, right? And I'll get into it a little bit further. There's a way to do it so you can not pay any taxes at all. If you purchase the qualified replacement property, when you sell it later, you'll pay taxes. So that's just a deferral. You can hold that property forever, and so the tax is deferred forever. But if you set it up properly with your estate, you can sell your business and not pay any taxes. The second is to the business. If you're a C corporation, you can deduct the principal and interest payments like I spoke about earlier. So think about that. You take a loan to set up a benefit for your employees, and you get to deduct all the principal at the corporate level. That's a great benefit for the business. And here is what is so important for cannabis companies, which I have some great illustrations coming up later.
Perfect.
If you're an S corporation and you're 100% S corporation, so the S corporation, so the stock of your S corporation is 100% owned by the ESOP, you are a tax-free entity. So Jay just asked a question about getting deductions. If you're an S corp, you don't need to worry about deductions because there's no taxes. So
Yeah, so it's a little different. You don't have to worry about the 280. Well, will you get into like how 280E plays into this later on?
yes, I will.
Okay, so yeah,
We have a slide for this later.
we'll answer that, Jay, in more
Okay.
detail.
Yes. And how does this help your employees? Well, the employees are now shareholders of the corporation. So the employees, not only will they create retirement wealth as you go through time, but they're incented to make the company do better, right? So because of that, the employees benefit, they're owners of the company, everyone's rowing in the same direction. And if the company does well, the share value goes up over time and your retirement accounts go up over time. So your work every day directly affects the stock value. So everyone's rowing in the same direction. So, and I have a few more slides here, which I will show you later. The people who work for ESOP companies have much, much more retirement wealth than people who work for companies who just have a 401k.
Oh, nice. And so we have a question from Tanika about will tax deduction be pending the valuation of the ESOP?
No, it will not, because the tax deduction is based off of the loan, not the stock valuation, but based off of the loan each year. So, and again, I will have I have an illustration of it. All right, so how do these things work, these employee stock ownership plans? So let me first go through a non-leveraged ESOP. So I'm going to turn to my notes for a second here. So let's pretend our company is worth $50 million, right? That's the stock value of the company. And you would like to transition the company to the employees. So each year, so let's say we're going to do this over 10 years. Each year, the company will contribute $5 million to the ESOP trust. Now, the company sets up a trust. It's a completely separate legal structure from the company, totally outside of the company. And that's $5 million will go into the trust. And then the trust will buy $5 million of stock from the shareholder, and then the shares will go into this trust. So now the employees now own $5 million of stock, and each employee has their own account set up. So to make things easy, let's just pretend there were 100 employees. Each employee would own $50,000 worth of stock, right? That is if everybody is treated equally. Now, generally, the way shares are awarded in ESOPs are based off of overall compensation. So the higher compensated employees get more stock, the lower compensated employees get less. But I was just trying to make the math easy. This contribution, this $5 million contribution that the company made to the ESOP trust is fully tax deductible. So that is a write-off on their taxes because it's an employee benefit. So over time, over 10 years, the employees are going to own all of the company. Now, interestingly, the employees own the company. However, if 10 employees or half the employees get together and say, hey, we're going to take over the management of the company, it doesn't work that way. The stock is held in the ESOP trust for benefit of the employees. The trustee is the only one with voting rights for the company. So the management team keeps running the company as a whole, right? And employees can't say, you have to run the company this way. The stock is held for benefit of employees, right? They don't get the voting rights of it. And the trustee works hand in hand with the management to make sure the company is working well. So this is just the overall how a non-leveraged ESOP works. So how people will, employees will get shares of stock. Now let's go to the more complex one, and which this is what we see the most, which is a leveraged ESOP. So again, let's take that same $50 million company. So that $50 million company will go to a bank and it will borrow $50 million. The company borrows $50 million, not the ESOP trust. And the company has set up the ESOP trust. So then the company loans the ESOP trust $50 million. It's a pass-through rate over here. And then the ESOP trust takes the $50 million, purchases all of the outstanding shares of the corporation, and pops it into the ESOP trust. So now the ESOP trust is a 100% owner of the company. However, the employees don't own 100% of the company yet because the shares have to be awarded to the employees over time. So each year, let's say we took a $50 million loan, we're going to pay it off over 10 years. So each year, the company makes a $5 million contribution into the ESOP trust. $5 million of shares are released to the employees, right? So now the employees own 10% of the company, right? And then that $5 million, which went into the ESOP to release the shares, the ESOP trust gives it back to the company, and the company pays the bank loan off. So between the company and ESOP trust, this is all internal accounting. The only real cash going anywhere is between the company and the bank. This internal accounting is for tax purposes. So you get that $5 million write-off each year from your earnings, and the ESOP trust, the employees are starting to earn the company over time.
So anything that goes into the ESOP trust must be dispersed to the employees. It can't just sit there.
No, that releases stock to the employees.
Okay.
Right. So the stock is released to the employees each year. And the reason it's done that way, you could actually set it up, and you're allowed to set it up that way if you would like. You can give the employees all the stock immediately if you would like. However, this is a retirement benefit. You want people to stick around and stay in the company for years, so they have to vest over time to own the company. Just like in the 401ks, it's sometimes there's a 2 or 3 year vest to get all the company contributions. So usually these plans are set up so that you vest your shares over multi-year periods. And that actually that's for retention. It keeps people in the companies. But the important part here is the loan just is between the company and the bank. And all of this is internal accounting for tax purposes. And as you'll see, taxes are a big deal with ESOPs. So Bruce Anderson just asked the question, yes, that $5 million is used to pay down the loan, right? So the $5 million that flows from the company, it's all paper. It flows from the company to the trust to release the shares to the employees. And then the trust gives back that $5 million to the company, and the company pays the loan.
Oh, so it's just paper. Like
Exactly.
There's no revenue generated to pay the loan.
Exactly. The company is paying off the loan, right?
So they're just taking money and giving it back and then doing some paperwork in the background to make.
Correct. So there's 2 things. There's an inside loan and an outside loan. The outside loan is between the company and the bank, right? The inside loan is between the company and the ESOP trust.
Now, does the company charge anything for that loan to the ESOP trust? Any interest?
Nope. It does. It passes it through from the bank.
Oh,
it's just a pass through from the bank.
So then how does the ESOP pay that interest?
It goes, the company's paying everything.
Okay.
But the deduction is generated this way with the ESOP. Okay, so the tax deduction is generated that way.
Okay, so now Bruce is asking.
So the ESOP trust actually has no money. All the ESOP trust owns is shares. It owns shares of the corporation.
Is it me or is it Rick? Okay. Okay, you're back.
Yeah, okay. So the ESOP the ESOP trust, all it owns is shares of the corporation, right? And there's a loan between the ESOP trust and the company. So as that loan is paid down, the shares are released to the employees. Okay. And the company gets all the tax benefits of interest and principal.
All right. So now, and you might get into this later, let us know, but they want to know how this looks to the employee.
So all the employee will see each year, and it's just like a 401k statement. The employee will see each year how many shares of the company they own, what the shares are worth, and the vesting schedule. So for instance, if you have a 3-year cliff vest, you're awarded shares in year 1, right? And then you're awarded more shares in year 2, and you're awarded more shares in year 3. And after year 3, the shares from year 1 vest. After year 4, the shares from year 2 vest, right? And they vest along the time periods. So each year you actually receive, and you'll see what shares you own that are vested and what are non-vested.
Yeah. And so now Bruce is asking about so the employees get stock with no money behind it. So what my understanding is, just from this brief talk, is the money behind the stock is the whatever valuation of the company was determined when the ESOP was first established.
Exactly. So
and you'll get into that valuation calculation, right?
Yes.
Okay.
So the ESOP trusts owns all of the shares of the corporation, right? So the employees get stock, but they get stock in the corporation. So there's plenty of money behind it. It's all the cash flow and the business flow of the company, right? Because this is 100% ESOP that we're talking about here. So this ESOP trust owns the company. And so each year when you do the stock valuation, you'll see how much it's worth.
Okay.
Okay.
There's a lot of questions coming in. So let me know if you want to do these one by one, or if you think the remaining presentation will probably cover.
Why don't we go just through a couple of the benefits,
Okay.
and then I will
jump back over there.
I can jump back into this, and I'm happy to stay on as long as anybody wants to answer any questions here. So an ESOP is wonderful because it's extremely flexible, so you can tailor things to benefit the company and the employees very well. But because it's so flexible, it can be complex, right?
And you'll get into this, but it's a very expensive thing to set up because you need a huge legal team, is that not?
Shockingly, it's less expensive than selling your company.
Oh, okay. Well,
believe it or not.
Wow. Okay.
Yes. All right. So let's go to the benefits, because this is the important page. So when I talked about the capital gains deferral, if you're selling your company, if you sell in your company as an ESOP for $80 million and you only have $1 million of basis, there's $79 million of gain. However, if you buy the qualified replacement property, right, and hold it, you pay no taxes. So you've retained basically $80 million, right? You don't need to worry about the gain because you bought qualified replacement property. Now, when you sell the qualified replacement property, you'll pay long-term capital gains on that. Compare that to if you sold your company to a third party, right? Private equity, third party, IPO'd. That's if you sold it for 20% more, okay, 80 versus 96, right? And you paid taxes on it, you would still receive 16% less. So you sold your company for 20% more and you're receiving 16% less because of that. So, and this was codified in 1973 with ERISA. So it's been around since 1973, and the IRS likes this, And the government likes this. Republicans and Democrats like this because it helps business owners not pay taxes. It helps employees build retirement wealth over time, and it really spreads the wealth down. So both sides of the aisle like ESOPs. So this is good for your business owner. Okay, how about the company itself? Well, when we set up an ESOP, like I mentioned before, you are borrowing that principal. That principal is tax deductible over years. So $60 million of principal borrowed, you get the present value of these deductions over 10 years, right? So if it was all in the first year, 16, it would be 16, but you're just getting the present value of the tax stream over time. So if you didn't do an ESOP, it would be 16 million, but when you do the ESOP, you're saving about $3 million in tax savings when you do this, right? So if you're an S corporation, this is the lovely sheet here, you don't pay taxes. So, and wait till you see the next page that we're going to pop up here. So if you're and this, you can go through this later, but if you're a regular C corp, you are paying your pre-tax income. You have distributions liability, and you also have dividends if you're paying those out. So you're paying taxes on this, right? So your $10 million of pre-tax income is only 5.5 now. If you're an S corp and you're making distributions to your shareholders, right, it's a little bit better tax, but you're at 5.8. If you're an ESOP, 100% owned ESOP, so you're an S corp, 100% of the shares are owned by the ESOP, you don't pay any taxes.
Wow.
So and why don't you pay any taxes? Because an ESOP is an employee retirement benefit plan. By their design, employee retirement benefit plans don't pay taxes. Pension funds don't pay taxes. So is why this is such a great deal. Now, let's get to the cannabis space. Now, this is something I just changed about a month ago, and I changed it a month ago because the President Trump said, "Hey, why don't we take cannabis from a Schedule 1 to a Schedule C?" And he put an executive order in. Now, who knows how long that's going to take to do? But at any rate, let me show you how this works. And this is actually fantastic, whether you're Schedule 1 or Schedule 3, what it will do, what an ESOP will do. So this is a hypothetical example. So let's say your cannabis company has $25 million of revenues. And the cost of goods sold, your cannabis, right, is $4 million. Well, your business operating expenses, your rent, your employees' salaries, your marketing, whatever your business operating expenses, those are not deducted. Those are not deductible under Schedule 1. So your taxable income, you can deduct your cost of goods sold, but your taxable income is $21 million. So you're paying taxes on this $21 million, right? So that's a lot of taxes. And then you still have to pay those business operating expenses. So your profit from $25 million of revs is only $2.6 million because you're Schedule 1. That's an implied tax rate of 76%. That's like much more than Sweden.
Well, yeah, and that's very reasonable. Anybody who understands 280E, we know that we're at like 70% tax rates in the cannabis industry.
It's crazy. So let's say you want to sell the company now. Now, cannabis companies get a much lower multiple because of uncertainty. People are very afraid of it. So if you had a regular $25 million company that was selling beer, right? Selling beer, right? You'd get a multiple of 5 or 6. But because it's cannabis, unfortunately, you're getting a multiple of 2. So your $25 million revenue company is only worth $5.2 million probably. Right? That's under Schedule 1 because of this 280E undeductibility of normal business operating expenses. If cannabis does go to Schedule 3, right, that $25 million, $4 million, and $10 million of operating expenses, right, these two are all deductible. So now you have $11 million of taxable income. I'm assuming, by the way, a 40% tax rate on this. So that's now $4.4 million of taxes. So look at your profit from Schedule 1 to 3. You've gone from 2.6 to 6.6. We're still going to give it the same 2 multiple. Now your business is worth 13.2, more than a double, just from Schedule 1 to 3. Now, so that's wonderful. Well, I've taken my business from 5.2 to 13.2 just from the descheduling. Well, how would you like to go from 5.2 to 22 million? So that's the beauty of an ESOP. So in an ESOP, you don't need to worry about taxes whatsoever. So you take your revenues, you take your cost of goods sold, business operating expenses, your taxable income is not taxed. So if we take and we apply that 2 multiple to that 11, your business is now worth $22 million.
So it doesn't matter what Trump says, Schedule 1 or Schedule 3.
Correct.
ESOP, this is your picture.
Correct. I put Schedule 3 in just so we could all see the difference about what happens when you go from 1 to 3. But if you go from one to an ESOP or 3 to an ESOP, you're still increasing your valuation tremendously. And by the way, that valuation will go to when the shareholders sell the company, as well as the employees over time. So this is, in our opinion, this is a great deal for cannabis companies, especially with the 280E. So, all right. Let me also get to this shows what a great deal this is for the company itself. And I talked a little bit about the valuations and how that's going to be good for the seller of the business, as well as the employees going forward. But what's been the experience in general with people who work for ESOP companies? So the average contribution to an ESOP is 2.5 times that of a regular 401k. So if you're working for a big corporate plan and you get 401k plan and your employer matches for you, you might get, I don't know, $25,000, $30,000 a year. You're going to get 2.5 times that if you're in an ESOP company, because ESOP companies have good cash flow and they tend to be more generous to the employees, because the employees, everyone's rowing in the same direction, as it were. And if you look at ESOP employees versus regular employees with just good old 401ks across all of the ESOP companies and all of the companies that have 401ks, the average employee has more than twice as much in their retirement account. Nice. That, say, $55,000. Keep in mind, this is across the whole country, versus $22,000. So ESOP companies do better for their employees and they're more generous to their employees. So, ideal candidates for an ESOP: closely held businesses. That's very important. Closely held business that don't have formal exit or transition strategies. Middle market companies with revenues anywhere between $3 million up to $50 million. Companies would like to raise cash or capital for expansion. And by the way, you can do an ESOP anywhere from 1% to 100%. So if you want to do an ESOP, you could say, I'm going to only sell 1% of my company. My employees are only going to earn 1% of the company over time. You can do that. You can do 100. You can do anywhere in between. Like I mentioned, ESOPs are very flexible. And you want to do a partial sale, like I just mentioned before, and sell a minority interest into friendly hands. Your employees, I sure hope, are friendly, right? So it's a very good idea to do this, to do an ESOP. Now, what are the benefits? So So many benefits for an ESOP. If your name is on the company and you want it to continue going forward, you want it to be in friendly hands with employees who've owned it. So legacy is important. Most ESOPs are small and mid-sized businesses in a community. So they're helping the community, and it's good to keep these in small and medium-sized towns. Huge benefits to the employees over time. Um, we just did an ESOP that was a distribute. I have to talk very carefully because law. Um, it was a distribution company in Massachusetts, and it had been an ESOP for 35 years. And we did a private sale of the ESOP company, and it was 100% employee owned. A private sale of the ESOP company to a very large distribution firm, and people who'd been working in the warehouse, for 20, 25 years, were retiring with $5 and $6 million. So
Okay, so the money. Oh, okay. We'll get into my questions, but continue.
um, um, you know what? You can all read this over time. I'm just trying to explain what good benefit is. I think what would be much more important is questions about it.
Yeah.
One
I
more
mean,
slide, and then
yep.
I'll take questions, until 5 o'clock tonight if you want.
And is it okay for me to make this presentation available?
Absolutely.
Slide deck?
Absolutely.
Okay.
Yes, please.
So that will be available in the members area, and if you don't have access, I dropped the link in the chat.
And if you don't have access to that, I'm on LinkedIn. You've probably seen this on LinkedIn. My email is on LinkedIn. Email me, and I'm happy to answer any questions as well as send you this presentation. So just let me know. So in order to do an ESOP, it usually takes about 180 days, right? And and the way we do it, and this is the way most ESOP firms do it, is we do something called the transaction analysis. We'll sit down with the business owners and determine how they would like to exit the business. And from that, we develop how much equity they want to take out of the business, how long the employees should take to own the business, how big a loan they want to take. Do you want to be an S corporation? Do you want to be a C corporation? Do you want to be a 100% tax-free entity? And we'll go through all of those here. And generally, this transaction analysis is between $35,000 and $45,000, depending on the complexity of the company. And we will do diligence, we'll draft a feasibility study, understanding how much the company can borrow. And from there, it serves as a roadmap to the ESOP transaction. And then for the transaction, we need a trustee. So we'll do an RFP. There's multiple trustees out there to find a trustee to take care of the ESOP. Right? We'll do a term sheet. And the trustee purchases stock of the company, and the trustee negotiates with the company to set a fair market value of the stock. And the reason it has to be a fair market value is because the company can't transact at a huge premium because it's a retirement benefit. So if you sell to private equity, you might get a bigger multiple. But if you do an ESOP, you're going to transact at a fair market value, and that's required by law. So we'll determine the fair market. The trustee and the company together will negotiate and come together to determine a fair market value. And then we'll negotiate with banks and to figure out the debt raise. Or and this will probably be very prevalent in the cannabis industry, you can do a seller note where the owner of the company sells shares of the company to the ESOP, right? And the cash flow of the company pays back the owner of the business. So you don't have to get banks involved at all, right? So seller note. And then the final implementation of the ESOP is you have to create a plan, and the plan has to be very have rules about how the shares are going to go to the employees, when the shares are vested, how the shares will come, and after that, you have to go to the IRS to determine if it is a fair plan. And And because that's important, it has to be fair for everybody, right? So, and then we do all the work from beginning to end. And then after the ESOP happens, we still have clients and we advise them each year on how to run the ESOP and how to make sure things work well. All right, so with that said, let me pop back to, I think most of the questions are going to be here. So let me pop
Yeah.
here and we can answer questions about the structure, how it works, and benefits to everybody.
Yeah, so just pop your questions in the chat and we'll get to them. I want to start with this one here about the company being insolvent or bankrupt. What happens?
Good question, Adam. So if the company becomes insolvent and goes into bankruptcy, the owners of the company, they're shareholders of the company, right? So equity, unfortunately, is the last on the capital structure. So the debt holders get paid off first, and then vendors and equity is at the bottom of the capital structure. So yes, if the company is being run poorly and it goes out of business, yes, those employees' stocks are worth that it becomes worth zero, right? And we don't see that happen very often because the employees are working at the company and they see how the company is being run. Keep in mind, there's also a trustee, and the trustee makes sure the business is being run properly. And if it isn't being run properly, the trustee can replace the management team.
Okay, nice.
Right? But generally, the management team and the employees they're all rowing in the same direction, right? So we don't see this very often. It does happen. It does happen. Let's say you were a company that was doing some specialized paint, and all of a sudden that solvent is no longer available for the paint, right? It becomes illegal. Well, there's nothing you can do about that. So yes, unfortunately, this is a situation with all of your eggs being in one basket.
I want to go back to this question because I want to understand. So if I was the employee of a company and they decide to implement something like this, because employees come and go and the life cycle of an employee is different. At what point, so when they implement the ESOP plan, do they have a set exit date? Like at what point will I know that I'll get the money from my investment?
Yes. So when you create the plan is a legal document. Okay, when you create the plan says when you are allowed to get your investment back. Now you have to be vested, of course. So say you're there for 2 years and there's a 3-year vest, you're not going to get your shares. They're going to be forfeited and go back into the ESOP trust pool to be distributed back to employees again. But let's say you've been in the company 10 years and you leave. In the plan, it can go several ways. The company can buy the shares back from you, right? And that happens once a year, by the way, because the company is only valued once a year. They do a valuation on the company each year, so you know what your shares in the ESOP trust are worth. So you've been there 10 years, your shares are fully vested. You are going to, and the company says in the plan, we're going to buy the shares back. You'll get your shares back. Okay. Now, let me tell you a personal thing. So the first company I worked for out of college, I was an engineer, and I worked for an environmental engineering firm, and they had this thing called an ESOP. And they gave me 25% of my salary every year in this stock, and I thought it was wonderful. I'm like, hey, this is really cool. Well, 5 years after I started working there, I wanted to go back to business school. It's like, okay, well, wow, I have this tuition bill here, and I have this ESOP thing, and I'm fully vested. So I went to HR and asked if I could cash out and pay a penalty. And they said, oh, no, Rick, you can't have your shares until you retire.
Oh.
Right? Now, it depends on how the plan is built, right? But this was a plan the plan was built in the late 70s. So I was like, well, darn, I guess I have to take loans. And I took loans because I had to. And I'm still not retired yet, but I still get my statements. I get my statements every
Oh,
year.
so you get to keep it. You don't have to retire with them.
Correct.
Oh,
Correct.
God. Okay.
You have to be the way the plan was written, I had to be of retirement age.
Got it.
So when you officially retire, then I could get the shares back. Well, they've been sitting in this company since, the 1980s. I'm like, okay, whatever. And I get my statement every year. And I thought, oh, these are, it's okay. This is doing better each year. This is good. Now I get the statement. They're a publicly traded company now. However, a bunch of the publicly traded shares are still held in the ESOP trust. And I look at it and I'm like, oh my God, this is 30 years of compounding. This is worth a lot now. So
Nice.
it's a lovely retirement benefit for me when I finally retire.
Yeah. Nice.
So when you set up the plan, you determine when the employees will get the shares. And I do know that my plan, because I've read it, the company is allowed to either give me a lump sum when I retire or give it to me in 3 equal payments over 3 years. So, and that's the company's decision. So, but that's how the plan is written.
Okay, awesome. Now, Kevin is asking, how is it determined how many shares the ESOP trust owns?
So the ESOP trust is going to buy the shares from the corporation, right? So if the corporation has 10,000 outstanding shares, right, it'll be 10,000 shares, right? And then and when those are awarded to employees each year, you can award partial shares too. So
the company just determines how many shares they want to.
yes.
Okay.
There was a question a minute ago, what does this look like to an employee? So I can tell you exactly because I've been getting my statements every year since 1985. So you'll get a statement each year, and each year you will see the valuation of the stock, how many shares you own of the stock, how many shares are vested, and how many shares are non-vested. And most ESOP companies have 401ks also. And so the ESOP tends to be a bolt-on to the 401k. So you get your 401k statement and you'll see, all of the mutual funds and publicly traded stocks that you own. And then you will have your ESOP underneath that.
Okay.
Okay.
All right.
Still have
Someone's
taxable?
asking about C Corps and taxable income.
Yes, C Corps have taxable income. So C Corp is not like an S Corp. So you do have taxable income. But the benefit of an ESOP for a C Corp is you get the employee retirement deduction from your taxes.
Okay.
So it's not
And this
like,
is also helping with, in the event of when you want to exit the company, selling the company, not having a huge capital gains tax.
correct.
But
So
your regular operations, you're still going to pay, taxes. You'll get, deductions of if you're using a loan to do the ESOP and things like that, but you'll still have other taxes.
correct.
Okay. Let's see. Bruce is saying the employee is vested and owns 1,000 shares at a value of $10 a share. The employee wants to cash out. Where's the cash?
The cash comes from the company. Okay. So the company will make a distribution to the ESOP, and then the ESOP will pull the shares in, give the cash to the employee, and then because keep in mind it's the benefit is going up and down. Mm-hmm. So and Bruce, this is an excellent question. So what happens as your employee base ages? People will start to retire and cash out. So there is, and this is really interesting. Years ago, it was much harder. You had to sort of figure out how old the employees are and make guesstimates. And now the third-party providers who do the ESOP accounting for you have software which you put your employee census in, and the employee census will tell you, okay, most likely these are who you're going to have retiring over these years, and this is how much money you're going to have to put aside in order to buy the shares back for the employee who retires, right? So I actually have a friend who's works in HR. for an ESOP for a place called PSI, Physical Sciences Inc., which does all government contracts, and it's been an ESOP for 35 years. And so she said, "Oh, Rick, it's so easy." She goes, "I just log in, put the census on, and then I tell our controller about how much money we're probably going to need to fund for the year." She goes, "It's always very, very close."
Nice.
So it was harder a long time ago before there were enough ESOP companies and people were able to build the data and figure this out. So, but now that it's been in for such a long time and software is so easy, it makes the planning extremely easy. And by the way, when you are setting up the plan, when I mentioned before, when I retire, they can either give it to me in a lump sum or give it to me a third over 3 years. That's how the company can help manage it too.
Right. And then Tanika's actually asking a question about that lump sum. Like, do you have to pay, as the employee, pay taxes on that?
Again, Tanika, excellent question. You don't have to. Isn't this wonderful? So it's an employee retirement plan. And when you cash out, you can put it in a rollover IRA, right? Now you'll pay taxes when you take it out of your IRA, but you get a big lump sum. It's a retirement plan. So it's just like when you cash out your 401k and roll it over into another 401k, it's the same thing. So you just pop it into your rollover IRA, and you can even create a rollover IRA if you don't have one, right? And from there, you don't have to pay taxes until you withdraw it. So this is it's just a wonderful tax deferral mechanism. The government is eventually going to get their taxes, right? But it just will take a long time.
And so a question for me came up. I don't see any more in the chat. So if you guys have any more, let us know. But I guess I want to better understand the mechanics. So the company is selling the company to the employees.
Well, they're letting the employees earn the company over time.
Right? And then if the company were to actually do a sale or a buyout or something, then how does that impact this ESOP setup?
So if the company is going to do 100% sale of the company, the employees down here own the company, right? So the employees will get paid out, right? And again, if they don't want to pay taxes, they can put it into a rollover IRA. If they want to realize some income, they'll pay the taxes on that income. And by the way, that's a long-term capital gain.
And then what does the company get out of that then if they've sold it and they don't own?
The company is owned by somebody else now, right?
And so I guess okay, so like if I had a company that I started and it cost $1 million to start and now it's worth $10 million, and I've done this ESOP thing and then I decide to sell it, I'm not really getting the benefit of the $9 million gain, or I got it over the time?
You've already received it.
Okay.
You've already received that because
I sold it to the shareholders.
Correct.
Oh, okay.
You sold your shares to the ESOP trust, right? So, and you got the benefit of those taxes beforehand. The other great part about if you are selling your company, but you are still managing and you don't own the company anymore, the employees do, but you're part of management and you own the company and you're working for that company, you get shares in the ESOP too, right? Okay. So you sold your company, but you're going to still get shares in the company over time.
Oh my gosh. Okay.
Right? So that's a double benefit for you.
Tanika's also asking, is there an age withdrawal rules or anything like that?
No.
Maybe it depends on how it's set up. Like yours is for only when you retirement.
Yeah. So when you retire, you're going to get the payment out, right? Mm-hmm. So there are age withdrawal rules when you put it into the rollover IRA.
Oh God, right? Yeah.
There will be on that, but there's no age withdrawal rules. Like if you're working at the company, you're 80 years old, and no, I don't believe there are any.
Okay, awesome. Well, thank you so much. Looks like we got through all the questions right in time. We got 5 minutes. Yeah. So,
All right. Well, Naomi, thank you so much. And anybody who is on the chat, we will send this out. But let me show you the last page here. So all my contact information.
yep, go ahead and
Right.
screenshot that if you have somebody that wants to take advantage of this.
Right. And I'm happy to talk to anybody anytime about this. My job basically is to be an ESOP evangelist because we are actually, honestly, we're very mission focused, and that's all we do. That's all my division does is ESOPs, right?
Nice.
And we've been doing it since 1990, I believe. And we have literally done, no kidding, 4,000 or 5,000 deals over this time.
Wow.
We tend to do 30 or 40 deals a year, right?
Nice.
So it adds up. It adds up over time, and there isn't anything in the ESOP world we haven't seen, right?
Nice.
So
Very interesting. And is it something that's because this is my first time hearing about it? Like last year was my first time ever even hearing about it.
right.
Is it maybe just in the wealthy? I mean, is it just now becoming more well known since you guys have been doing it for so long, or is it just more so in a different?
It's not an often utilized strategy, and it's too bad because you've seen all of the incredible benefits to it. Part of the problem is it's complex,
Mhm.
right? But it's complex because you can build your exit the way you want to build your exit,
Right.
right?
Okay.
And there's all kinds of tax law that comes through here, but for the right company, I mean, these are just wonderful.
Yeah. Awesome.
So,
All
so
right. Well, thank you so much for your time.
Naomi, thank you so much, and please feel free, anybody, to contact me, and I'll talk about it. You can probably tell I'll talk about ESOPs all day.
Yep. That's how I met you. All right, you guys, we're going to go ahead and end it there, and stay tuned for the announcements for our next presentation.
All right.
Take care.
Thank you, Naomi. Thank you, everybody.
Bye.